Hi, welcome to this my eighth update for my date of 2019. I'd always planned to write this particular update about dividends and buybacks, but a recent op-ed in the New York Times by Senators Schumer and Sanders may make this post seem reactive. But my objective is to take a look at some of the things that the senators have said about buybacks in their op-ed and their proposed legislation to restrict and perhaps even ban buybacks. Any debate or discussion about buybacks becomes heated very quickly because people are set in their ways. And at the end of the discussion, it seems like nobody's mind has changed. They all walk away convinced that they were right, and the other side's arguments fall on deaf ears. So I wondered why this happens, and I think it boils down to difference in perspectives. Depending on how you think companies behave, what drives managers, and how markets set prices, you're coming from very different places to divide, and not surprisingly, you come to very different conclusions about buybacks. So I'm going to present three very different perspectives about buybacks, and I have my biases, but I'll try to keep them out, at least for the next few minutes. From the perspective that buybacks and dividends are benign, here's the way the world is supposed to work. If you're a company, public or private, here's what you do first. You look at the investments you have and you pick good investments and you reject bad ones. What are good investments? These are investments that earn more than your hurdle rate. So if you can find good investments, you start by investing in them. To the extent that you might not have enough funds to cover those investments, you either can come up with fresh equity, bring in more equity, or you can borrow money. And that decision, if you are in this benign world, is driven by how much debt you can afford to take. Your desire to minimize your hurdle rate. So you take the right amount of debt, you take good projects. At the end of the process, though, if there is any cash left over, it's residual cash. Remember, this is cash left over after you've met your reinvestment needs. You've taken the good projects and you've essentially paid off the debt holders. You return that cash to investors. Now, that cash return can take the form of either dividends or buybacks, and at least in this world, it doesn't matter. It depends on what your stockholders would prefer. Some stockholders prefer dividends, others prefer buybacks. Now, if the world followed this particular script, buybacks are benign because they come out of residual cash flows. They're not coming at the expense of good projects. Buybacks, in fact, are creating value for shareholders or collecting cash from the company, and that cash finds its way into better uses, other companies which might have better projects. So that's your buybacks are benign in a perspective. There's a second perspective, and in this perspective, buybacks are short term. And here's what drives them. Managers are intent on increasing earnings per share. Why? Because if you can increase earnings per share, and markets are myopic, that's the other half of this perspective, your higher earnings per share will translate into higher stock prices. How do you make your earnings per share higher? Well, buybacks reduce your share count. By reducing the number of shares, your earnings per share mathematically should be higher. And if you borrow money to fund some of your project, that helps you even more. In fact, if you can borrow money and buy back shares, you get a double whammy. Your earnings per share shoots up. And if the market is myopic and ignores the fact that you're not taking good investments, it shouldn't, and if it's a rational market, but let's say it's short term, it just looks at the earnings per share, it'll reward you with a higher price, notwithstanding the fact that you're not taking good projects and you're taking on too much debt. And of course, this particular perspective gets added ammunition when managers are compensated with equity, with either options or with the restricted stock, because there they get the benefit of the higher stock price almost immediately. They can cash out and move on. So in this perspective, buybacks can be damaging, especially for companies with good long-term projects, but where managers are attuned to short-term demands to have higher earnings per share and earnings per share growth. There's a third perspective, and in this perspective, buybacks are truly malignant. They destroy the company from the inside out. And in this particular perspective, companies are focused entirely on returning as much cash as they can to the owners. So essentially, they do everything they can to increase how much cash they have available to buy back stock and return to the owners. How can they do this? They can start on the factory floor by restricting wage increases. They pay their employees less. Why? Because that increases earnings and cash flows available to be paid out. They borrow as much as they can, perhaps more than they can, so that they have more cash available to buy back stock. And those buybacks then translate into less projects. They reinvest less, they pay their workers less, they borrow more, all because they want more cash flows today to use on buybacks. And of course, that process is driven by two forces. One is greedy activist investors. You need those pushing companies to do it. And these greedy activists and perhaps some large institutional investors push companies to return more cash. And because everybody else in the sector is doing the same thing, peer pressure also pushes towards buybacks. In this particular view of the world, buybacks can be extraordinarily devastating. Because by buying back more stock, not only are companies not reinvesting in projects they should be taking, they're also paying their employees less, and they're also probably borrowing more money. In fact, in this view of the world, buybacks are responsible for a trifecta of America's corporate evils, right? They're responsible for the fact that companies have too much debt, they don't reinvest enough, and that they don't pay their employees very much. And if you're somebody who buys into this perspective, your good and evil get lined up. So if you're a populist, this is your wet dream, because the good people in this particular perspective are workers and small stockholders in society, and the bad people are, of course, activist investors and some bad institutional investors. It could be it is essentially markets that are that are driving this process, and this is the perspective that I think Senator Schumer and Sanders bring to the game. Now, I cannot rule out any of these perspectives. There is an element of truth to all of them. They're all plausible. And in the real world, which is a messy place, you could argue that there are some companies where buybacks are benign. They're using buybacks because they have cash left over after they've met every other need. There are some companies where buybacks are driven by short-term considerations because managers want to increase earnings per share, push up the stock price, and perhaps collect higher compensation. And there are some companies where buybacks are in fact malignant, where they are destroying the companies from the inside out, in the process creating huge social costs. Now, rather than give you which perspective is right, because I don't know, all three perspectives could hold, and there are companies within each one, here's a one note of caution I would add. If I give anecdotal evidence, I could find companies that fit my perspective. And my concern with the buyback debate is anecdotal evidence is front and center. Senator Schumer and Sanders use Walmart and Harley Davidson as their examples. I could give you counterexamples to illustrate a different perspective. So rather than caught up in your anecdote versus my anecdote, here's what I'm going to do. I'm going to play some money ball with the data. I'm going to look across companies. After all, the question of whether companies are driven by benign reasons, short-term reasons, or malignant reasons for buybacks is an empirical question. It's not a political one. It should not be an ideological one. It should not be an academic one. It is a data-driven question. So let's start with some basic facts. It is absolutely true that US companies are buying back more and more stock over time. In this graph, for instance, I've graphed out dividends and stock buybacks going back in time to the mid-1980s. You can see that over the last 30 years, buybacks have increased not only in dollar terms, but as a percentage of the cash return to stockholders. In 2018, for instance, about 60% of all the cash returned by the S&P 500, which is what this graph focuses on, the 500 largest US companies, about 60% of the cash took the form of buybacks. Let me follow up on that. It is also true that if I focus on accounting measures of net income, that companies are returning more of their income back to stockholders. You'll see in a moment why I use accounting measures of net income. You're saying, what other measures can there be? So in this graph, in this table, I've actually looked at the traditional way in which companies have returned cash, which is dividends, and the more new formed way, which is buybacks, and I look at the return in dividends and the total cash return, which is dividends plus buybacks, and I compute two measures. One is I divide the number, the cash return, by the market price. If I divide dividends by the stock price, I get the dividend yield. And if I divide and the second number, I divide the cash return by the net income. If I divide dividends by net income, I get the payout ratio. Now, the yield and the payout ratio are numbers that have been around a long time. In fact, investors you can go to Ben Graham's security analysis, and you see both numbers highlighted. The reason I want to look at the cash return number is people who get focused on the dividend number are puzzled by what's going on. For instance, dividend yields for US stocks have hit lows. They're saying, what the heck is going on? What we're missing when we focus just on dividends is more and more of the cash is taking the form of buybacks. Now, if you focus in on the cash return at companies, you can see that an increasing percentage of net income is being returned back to stockholders. And if you stay with that statistic, you might tend to believe that the malignant story about buybacks is true, that buybacks are coming at the expense of companies reinvesting more. Let me back this up. If you look at the cash return as a percentage of net income, so this is the percentage of the net income that companies are returning back. In 2018, that number was about 92%. 92% of the earnings of US companies of the S&P 500 was given back to stockholders in the form of either dividends or buybacks. You're saying, so what? Well, if you flip that around, only 8% of the earnings was being reinvested, right? So if your argument is US companies are not reinvesting, this table seems to back it up. And the reason they're not reinvesting is they're so busy buying back stock. But that may not be true if you start to count two factors that I think are ignored when we look at total cash return as a percent of net income. The first is, if we're going to count stock buybacks as cash returned to stockholders, we should also be counting stock issuances as cash coming from stockholders, right? Not a big deal with the S&P 500, but in this table, I've actually looked at cash return as a percentage of income. But I'm looking at all US companies, not just the largest companies. And here you can see that if I bring in stock issuances and I net them out against buybacks, it's a net cash return. That number tends to be smaller than not surprising, than the cash return number that you saw before. So that's the first fix, is I want to bring in stock issuances into the story. The other is, when I talked about earnings, I called it accounting earnings. Basically, this is how accountants measure earnings. And we know accountants have an inconsistency problem. And here's what the inconsistency problem is. If you're a conventional manufacturing company and you invest in a plant or equipment or a new factory, accountants count that as CapEx. And rather than expensing the amount right away, they let you spread it out over time, over the number of years that you get benefits, which makes sense. But if you're a technology company or a pharmaceutical company, think of what your biggest CapEx is. It's not land, building, or equipment, it's R&D. And accountants treat R&D as an operating expense. What I'm trying to say is accounting rules right now don't work across companies. What we measure as earnings for a GM is very different than what we measure as earnings for a Microsoft, because the earnings for GM are treating CapEx as they should be, as capital expenditures, but the earnings for Microsoft are after their capital expenditures. So here's a quick fix I did. I added back the R&D to the net income, and I computed the net cash returned as a percentage of that total money, R&D plus net income. And that number gives a much more sanguine view of what US companies are doing. In fact, in 2018, if you look at that number, it was about 46%, not 92%. So that rather than buy into the 92% that you get when you look at dividends plus buybacks as net income and freak out that companies are not reinvesting more, isn't it more sensible to look at this 46% and say, hey, they're reinvesting more, but they're just reinvesting more in unconventional places, R&D and acquisitions. And you can see over time that traditional CapEx, so CapEx that comes out of the financial statements, measures investments in land, building equipment, has become less than 50% of reinvestment at US companies. So I'm not as quick to jump on the bandwagon of those who claim that buybacks are devastating reinvestment, because I think we're missing how different reinvestment is today than it was 30 or 50 years ago. Let's keep going. If you look at buybacks cut across the board in the US. All kinds of companies do it, but certain kinds of companies buy back more stock than others. So I took three slices or three variables that I could use to differentiate across companies to see if there were differences. The first is I looked at different sectors, different industries to see if some kinds of businesses buy back more stock than others. And here's what I saw. The companies that buy back the least stock tend to be in sectors, tend to be in industries which have a history of paying big dividends. Utilities, oil and natural resource companies. They have a history of paying big dividends. They're not big users of buybacks. The companies that are the biggest buyers of their own stock, if you look at the list below, tend to be companies like pharmaceuticals and technology companies. Companies that invest in intangible assets. There are not a whole lot of manufacturing sector or manufacturing industries on that biggest buyback list. So the companies with intangible assets tend to be bigger users of buybacks than companies with physical assets. So if your rationale for legislating against buybacks is if you do that, there'll be more factories built. Maybe you're barking up, you're looking in the wrong place, because the companies with intangible assets are not building those big factories. It is true that big companies buy back more of their own stock than small companies. In this table, I've looked at companies in the US. So these are all US companies, because that's where the buyback phenomenon is greatest and the legislation is directed at them. You can see that the biggest companies buy back the most stock, not just in dollar terms, that's no surprise, but as a percentage of their market cap. So big companies buy back more stock than small companies. And finally, I broke companies based on their expected growth in revenues. I didn't use growth in earnings per share because that's going to bias you towards buyback companies. So I broke down companies based on revenue growth over the next 2 years. And the lowest growth companies are the ones that buy back the most stock. So in summary, if you look across the tables, here's what I see. The buyback boom is driven by big, low growth companies, predominantly companies with intangible assets. So if you're going to legislate against buybacks, those are the companies that are going to be buying back less, not big manufacturing companies. And my gut, and I don't have the empirical data to back this up, and I'll go looking, is the kinds of companies that buy back the most stock, the technology and the pharmaceutical companies, are the companies that pay their workers pretty well already. I mean, these are not companies that use minimum wage labor for the most part. So if your other reason for legislating against buybacks is you want companies to pay a living wage to workers, you seem to be looking at the wrong targets. Let's move on. Built into this, the Schumer Sanders argument against buybacks is a presumption that is shared not just by the left end of the spectrum, but also by the right end, which is that it's always better for companies to invest back in their own businesses than it is to return cash. I don't know where this presumption comes from, but it's a very dangerous one. Investing back into your own business is not always better than returning cash. In fact, I'm going to show you a table that I showed in an earlier post where I looked at the percentage of companies globally that take their money, reinvest back, but reinvest back in projects, assets, investments that don't earn their hurdle rate. Remember, the hurdle rate is what you need to make on an investment to break even. 60% of companies globally, and close to that number in the US, invest in projects that don't earn their hurdle rate. Now, if you look at the median spread between the return on capital, which is what you make on projects and the cost of capital, you can see it's negative around the world. So here's the bottom line. If you stop companies from buying back stock and you insist that they reinvest that money is going to get reinvested in a lot of projects that don't earn the cost of capital. Now, at this stage, you're saying, well, you're speaking like an investor. They're still building factories, so there'll be jobs created and it's good for the economy. Is it? When these companies return cash in the form of buybacks, what do you think happens to all that cash? It doesn't disappear into a black hole. It goes in investors' pockets, and much of that money gets reinvested back into other companies in other businesses. So here's what I think will happen if you stop companies from buying back stock and you force them to reinvest. They will reinvest back into themselves, but often those investments are going to be in bad businesses and bad projects, and it'll come at a cost, which is that capital will no longer be available for companies in good businesses that need the capital to grow. You're going to be investing, but you're going to be investing in the wrong places. From that perspective, this is not just bad for stockholders, it's bad for the economy. Now, of course, there is also the other part of the story that you're told, which is a lot of these buybacks are being funded with debt. That this is at the root of the debt frenzy, supposedly in US companies. In my last post, I noted that the debt frenzy story itself has very little legs. I mean, the data doesn't back it up. But let's see if in fact buybacks are being funded primarily with debt. And here's how I did it. I broke companies down based on their debt load. And the way I measure the debt load is I looked at the debt as a scale to its EBITDA. So debt divided by EBITDA. So if you have very little debt, you'll have a low debt to EBITDA. If you have a lot of debt, you'll have a high debt to EBITDA. I broke companies down into 5 quintiles. And I looked at dividends and buybacks in each quintile. Now, if you look at the bulk of the dividends and buybacks, they occur not with the highest debt companies, but companies that are lower in the spectrum, the second and the third quintile. And in fact, they represent almost 62% of the market cap of all companies. It is not the most debt-laden companies that are buying back stock. It is true that there are some companies with a lot of debt that are buying back stock, and there are some bad actors here. Some of these companies have no business buying back stock. But luckily, they're not a big chunk of the market. They're about 10% of the market. So I am concerned, like you are, about some companies buying back stock and fueling these buybacks with debt they shouldn't be taking. But they're the exception rather than the rule. Now, one final point about buybacks. If you believe that buybacks are a US phenomenon, you're wrong because they're starting to spread. 30 years ago, you were right. US companies were the only ones buying back stock. Today, the phenomenon is spreading. In this table, I've looked at buybacks across the world. It remains true that US companies are the center of buybacks. They do the most buybacks, but you can see Canadian companies are catching up. You're seeing buybacks starting in Europe, and the holdouts are in Asia and Latin America. Okay, so it is true that in Latin America and Asia, the companies are less likely to use buybacks. But before you view that as a good thing, I think it might have more to do with corporate governance in those parts of the world. If you don't like the fact that a bad Asian company is accumulating your cash and taking projects it should not be taking, my question is, what are you going to do about it? If corporate governance is poor, it's entirely possible that you're not going to get much cash return in the first place. It's also striking that Eastern European and Russian companies have among the lowest percentages of cash in the form of buybacks. So here's the bottom line. Right? I believe, and this is my view, and I'm not going to ask you to say accept my view, but this is my view, that I believe that buybacks are more a symptom of global economic shifts than the cause of these shifts. What am I talking about? The first is globalization. Over the last 25 to 30 years, we've become globalized. What does that mean? There are fewer and fewer companies which have nice protected domestic markets where they can earn well above their cost of capital. Everybody's excess returns are under assault. There are fewer good projects to take. So buybacks are reducing the chance for companies to take good investments. And if you cannot take good investments, you have to return. And this is especially true in the old economy companies, manufacturing companies, where globalization has had its biggest impact. The second big global development is we've gone from the smokestack economies of the 19th and the 20th century to a very different kind of economy, dominated not by manufacturing firms, but by technology firms and firms in general that invest in intangible assets. These companies are less capital intensive in a way, and these are also the companies where accounting seems to have the most trouble. So I think those macro trends are what's pushing the buybacks. And I think this global comparative factor is also having another effect. Not only are companies making less sure about their excess returns, they're also, the earnings that these companies are making are becoming much more volatile. When you have volatile earnings and your excess returns are dropping, guess what? You're going to return not just more cash to stockholders, but more cash in the form of buybacks. Because if you pay dividends, you got to keep paying dividends for the foreseeable future. Dividends are commitments, buybacks are less so. Now, of course, if you came in here into this session with a strong view against buybacks, you believe in the malignant story, it's unlikely that I've convinced you otherwise. So I accept the fact that you're going to disagree with me. But here's what I'd like you to think about. Assume that you succeed in restricting or even stopping buybacks. I think the question is what next? Assuming you can restrict or even ban buybacks, let's play through what the consequences are going to be. Are you going to get the outcomes you desire? Are you going to get companies investing more in plant and equipment? I don't think so. And here's why. I think you're going to give companies that used to buy back stock more cash to hold, but that cash has to find a place somewhere. Many of these companies were returning cash because they did not have good projects. So these companies will either have to invest in bad projects or do acquisitions. That capital, instead of going to somebody else, some other firm that could have found a better need for it, is going to get reinvested in all the wrong places. You're saying on the wage front we're going to succeed. Well, perhaps. Perhaps initially you can tie buybacks to whether companies pay higher wages. But you got to think through the effects of that as well. Initially, you might get a higher wage for the employees of the company that wants to buy back stock. But these companies looking forward are going to hire fewer employees. In fact, I would not be surprised if you saw the workforces of these companies become smaller because they're much more likely to take automation and replace employees. So over time, you're going to get a smaller and smaller subset of workers earning these high wages that you got them by restricting buybacks. But it's going to come at the expense of new workers entering the workforce. Now, of course, there is always the anecdotal evidence part, and it's not surprising to me that Walmart and Harley-Davidson were used as the examples to illustrate the ills of buybacks. I'm going to play along. Let's assume that Walmart and Harley-Davidson, instead of buying back stock, had done what the good senators had wished they had done, which is reinvest back in the business and pay their employees more. Let's see what would have happened. If Walmart had reinvested more back into the business, it's unlikely that they'd have opened more stores in the US, which is already an extraordinarily saturated market. If they were going to open new stores, it would be in India or China or Indonesia. Is that the reinvestment that the senators want the company to make, invest in other markets? Maybe they'd have done an acquisition, but the acquisition they did was a Flipkart in India. So if you're going to force companies to reinvest, that reinvestment can happen in places you don't want them to reinvest. You're saying, well, what about Harley Davidson? They could have built another factory to produce more bikes. The problem for Harley Davidson is not that they're not producing enough bikes, but that the demand for their bikes is limited. It's a niche market. And the reason they return the cash is they're not sure they can sell the bikes they make in these factories. So what would have been accomplished by building that factory? You would have given workers jobs, that is true. But those jobs would not have lasted very long if people are not buying bikes. On the wage front, it is true you could have forced Walmart to pay more to its employees. I'm all for a living wage. But let's think through the consequences. That would have effectively pushed up the cost structure for Walmart. And Walmart right now is terrified not of its brick and mortar competition, but of Amazon. You'd have made Amazon's job a lot easier. In fact, if you're one of those, and I'd wager there are many people out there who are concerned about how the FANG stocks, the big tech companies, are taking over the world, you want to, grease the skids and make it even easier for the FANG stocks to take over the world. Well, put even more constraints on traditional, conventional companies, and that's exactly what you'll be doing with buyback restrictions. You'll make it easier for Amazon to rule the world. So here's my bottom line. I think there are macro forces at play, and buybacks are more a symptom of those forces than a cause of them. Are there bad actors out there, companies that should not be buying back stock, that are buying back stock when they have good projects that they're rejecting, or buying back stock with debt that they should not be? Absolutely. But I am going to be naive and let those companies get punished, as they eventually will, by markets and by market forces. If you want to pass legislation, in this case, the legislation is going to be a bludgeon, not a scalpel. It's going to restrict not just the companies that you want restricted, but a lot of companies that should be returning cash to their shareholders. I know that the legislation has good intentions. We all share the same objectives. We want the manufacturing base for the US to get stronger and larger. We want workers to get paid more, especially at the lowest end of the spectrum. But as I've noted it already in this session, I think that well-intentioned legislation can often have perverse results. You can actually end up, I think, as a result of this legislation, with an even smaller manufacturing base and hurting the people at the lowest end of the wage spectrum. Thank you very much for listening.